So over the past few weeks, really, I've been saying that stocks are overbought. If you go back to the YouTube channel and you kind of look at all the things we've been talking about, we always talk about stocks being overbought. Now, I don't want this to be confusing, but we actually just got a buy signal in the S&P 500 for a very short trade yesterday, which was January the 30th. And I wanted to share this with you because it's important that we can sort of be able to contextualize different time frames. So I still think stocks are overbought, and I do think we're going to have a decent move back lower over the next few weeks or so. Nonetheless, there's a signal I want to show you that I think we have to heed for a potential trade if you want to do that. So let me flip this camera around and quickly show you what the Market Rover gave us. So this is the S&P 500. In fact, it's the SPY ETF. And I'm going to try to bring this camera as close as possible. And what you'll see is that green arrow. Let me just quickly zoom in a bit closer still so you can see this really well. Okay, and it's right here, that little green arrow. And basically what that green arrow means is that upon an up day of about 2% or so, there should be a further upside on an index between 1 and 3%. Now, that's the buy signal we got yesterday inside the Market Rover on the SPY. Let me just go back to a charting platform so you can see this a bit more clearly in terms of what the actual trade might be. So one of the things that I've been telling our clients about over the past few weeks is that even though I think stocks are overbought, there still is upside on the SPY to about 270 to 275. And sure enough, with this move here, with this breakout move, which was the confirmation of the buy signal we received a couple days ago, there is a little bit more upside. Now, it's not a lot of upside, so I don't want to get too excited about this. We're talking about another, I mean, 1 to, like I said, 1 to maybe 3, probably less, maybe 1 to 2%. So it's not a big move, but I wanted to point this out because I think one of the most difficult things that people have in making or trying to make money in the markets is to be able to keep time frames separate. And in fact, I think at the margin, those people who can keep their time frames correct, in other words, if you keep trades to trades, short-term trades to short-term trades, medium-term duration trades to medium-term, don't mix them. So if you have a short-term trade, don't turn it into a medium or long-term thing, and vice versa, and keep these time frames separate. So I'm still cautious on stocks here through the lens of a few weeks, maybe a few months. But this little trade idea here, if you want to get on a trade, it's something that to me could work. And you know what? If the market reverses back lower, you've at least tried it. You've given it a bit of a shot. So it's not a recommendation. I'm just simply telling you what the Market Rover gave us. And I want to just kind of, again, make sure one understands that it's important to be able to distinguish in time frames. In fact, it's probably the most difficult thing to learn when it comes to trading and investing is be able to keep things in different in their separate time frames. So that's it, folks. I'll see you tomorrow.